Which is more risky, stocks or options? Comment down below right now if you know the answer. But that's what we're gonna talk about in today's video. And this is part 2 of our series on options, and you can see part 1 somewhere. I'll put the link somewhere. But before we dive into this topic, you gotta check out this options trading report. This is a free report that you can get if you just go to the page, and the link to that page will be on this video and down below. You just type in your email address and I'll send it to you, and it is gonna teach you all the advanced things that you need to know about options. And this is probably the clearest explanation anywhere on the internet. I know because I helped make it myself. If you're serious about trading options, you need to read this stuff so that you're not a sucker. But anyway, we're going to continue going over this article that Tyler wrote at MacroOps, The Misconceptions and Pitfalls of Options Trading. I'll link this somewhere too. Oh yeah, and one more thing. Decorations, because all you comment on my kitchen environment all the time. This is my secondary kitchen. It's in my basement. We don't use it. But I know you want decorations on the table over here. So first decoration. My worst stock in the world award, given to me by the street. Yes, Jim Cramer. That's him. When he had hair. That's what he used to look like. We're gonna put this right here. Right here. How's that look? No? Alright, it looks kind of stupid, but you can't say I don't have decorations. The street actually, when I won that award, one of the editors was like, okay, can you be in studio so Jim Cramer can give it to you? I was like, well, I'm in Detroit, so you guys gonna fly me out? And they're like, nope. So I was like, nope. And then I didn't meet Jim Cramer, which is fine because that really wasn't on my bucket list. I mean, he's cool, I guess. But anyway, which is more risky, stocks or options? What a long intro. Now, on the one hand, one group of people will say that options are more risky because they're more volatile. But the thing about volatility is that it's not really a good measure of risk. So no, I don't consider options more risky than stocks because of their volatility. And on the other hand, people will say that options are safer than stocks because the loss is defined. You can only lose so much. And sure, it's true that the loss is defined in some scenarios, but that doesn't matter as much to overall risk management. So I wouldn't say that options are less risky because of that. The answer is that options and stocks have the same amount of risk. And that's because, as Tyler says here, risk is a function of position sizing, not product type. Get it? Position sizing. So Ray Dalio, we talked about his all-weather strategy, right? The risk parity. Well, all risk parity is changing your position sizes based off something like volatility. So if one instrument is more volatile than the other, then you just size lower to that instrument. If another instrument is less volatile than the others, then you size more on that one. And all in all, the average return each day of each instrument should be about the same. And that's risk parity, equal risk. So really the volatility itself is not as important as the position sizing. So Tyler has a good example here. He says, as an investor or trader, you always want to think of your downside in relation to your account size. Again, position sizing thing. Say you want to buy a call option because you think the price of a stock will go up. So again, a call option is the right to buy. So you buy a call option at 70 and the stock goes up to 80, you still have the right to buy it at 70, which you could turn around and flip at 80 and you make that $10 difference. But okay, you have a $100,000 account, and of course, if you buy that call option, there's a chance it expires worthless, and 100% of what you invested will be lost. But you get to choose what that 100% loss means in relation to your account. So if you invest all your $100,000 in those call options and they expire worthless, then yeah, you go broke. But if you invest just $100 in those call options, then as Tyler says, a loss of $100 on a $100,000 account is only a 0.1% loss in total. So your risk is all based off your position size. The option is not inherently more or less risky than the underlying stock. See, the option doesn't inherently have more risk than the stock. It all depends on how much you're putting into it. So he says the same argument is also used against sellers of options. Critics say, well, if you sell a naked put, you have limited upside and unlimited downside. That's a very risky position. So what they mean by selling a naked put is just you selling a single put. So you're selling the right to sell to someone else. So if you make a contract and say the person has the right to sell you shares of Apple at $100 and say Apple drops to $90, well, they'll buy up shares at $90 and then use that contract to sell them to you at $100. So depending on how you set up a naked option trade, you could technically have unlimited downside. But as Tyler says, the short put is not risky in and of itself. The risk depends on how many you sell. So he gives an example. So say if you bought 100 shares of the SPY ETF and spent a total of $20,644. Now imagine the market got kneecapped and sold off 50%. You would lose over $10,000 on that, 50% of what you invested. Now say on the other hand, you sold a put right where you would have bought shares, which was at 206. That same 50% decline would end up different with the options. So if it was cut in half, you would lose that $10,000, right? Around the same amount you would have lost if you just had straight stock. But because you sold that put, you're also getting getting that $445 credit. So really you only lose $9,800. So in this scenario, you lost less than if you bought the plain vanilla stock. It says right here, stock lost 10,000, put lost 9,800. So in this scenario, selling one put option was less risky than buying the stock flat out. Now say if you have that same example, but you buy two put options, well then it works out with the stock, you lose 10,300 again, but with the put, you lose almost 20,000. So the riskiness is not about the option. Again, it's about how many you bought, which is position sizing. Remember, position size determines risk, not product type. And this goes for any type of instrument, not just options. Just like you might hear people say that futures and Forex, they're all risky because of leverage. That is true in a sense that it's more risky for most people because they don't know how to position size. So you give them leverage, it's like giving them fire and they just burn themselves. But even leveraged instruments like options, futures, and Forex, they can be completely fine to use and actually extremely lucrative if you're sizing correctly. An entire strategy can either be super successful or super disastrous, and the only thing you're changing to make it one or the other is your position sizing. That's how important position sizing is to trade. And if you want to learn more about why it's so important, check out the option special report. I got a link in this video and then below in the comments too. Definitely get it, definitely read up. And we're going to be making more videos about options. So if you want to see those, subscribe to this channel and hit that bell so you get an email notification for when they're released. And if you got any questions or anything, just list them down below in the comments. We'll make videos out of those too. And if I don't know the answer, I'll just go ask Tyler because he's much smarter at this stuff than I am. I would say I have a prettier face, but nah, he's pretty too. I just have this amazing basement kitchen setup that, you know, he can't touch. But anyway, subscribe, comment, like, do all those things that help this video, and I will see you in the next video. Stay fallible out there. Bye.